Good afternoon, guys. So now let's jump to the seminar. So today we will cover question number 2, the NK limited, and in this question we will prepare the operating statement, and we will reconcile the budget profit with the actual profit using the variances. So if you look at the question, manufacturer NK Limited manufactures a single product, and they recently introduced a system of standard costing and variances for the 20,000 units they expect to sell and produce. So far, 20,000 units, it's the budgeted units, and as you see, sales and production are equal, so 20,000 units. Okay, so these are the budgeted figures, including material, 2 kilogram at 10 pound, at 20 pound, direct labor, variable overhead, and fixed overhead. This all are available for the budgeted figures. In terms of the selling price, which is the standard, the budgeted selling price is £50 per unit. In terms of the budgeted fixed overhead is a £25,000 total fixed overhead, the budgeted fixed overhead, right? Which is basically fixed overhead, it's 1.25 per unit. So if you multiply by the budgeted units, which is 20,000 units, you should be able to find this £25,000. At the year end, the directors are happy as the revenue is greater than the expected at £1,086,500. So in this case here, the question starts to tell you the the actual figures. So when you look here, where is it? Yeah, here we go. That's the actual figure, the total sales. Let's put it in the blue one. Yeah, the actual sales is this, and the actual units produced and sales units sold, 20,500 units. So okay, so if you do this, here we go. So if you want to find the selling price per unit, so what is the selling price per unit? Here the standard selling price per unit is £50, but here what's the really actual selling price per unit? So the actual selling price per unit, what you need to do, you need to divide this by the units. So let's do it. So 1,086,500 divided by 2,500, so that's £53. So £53. So £53 is what is the actual selling price per unit. Okay, actual selling price per unit, £53. Okay. Right, okay, now for the material, we used 30,750 kilogram of material. So this is actual figures again, guys. So, and these cost us £325,000, £950. So what you need to do in order to find the per kilo, which is like this, £10 per kilo, so you need to find also the per kilo, so you need to divide this by this. So if you divide this by this, so £325,000, £325,000, £950. If you divide it by 30,750 pound, so this is 10.6. okay, 10.6. okay, so right, so as you see, 10.6 here is 10, as I mentioned in the lecture. So you need to make sure that they are almost close. It's not close, but I mean this shouldn't be 100, for example, compared with 10. So you need to be a bit comparable in a way, so you can feel that this is the answer. I mean, can you imagine if this answer happened to be 100 or 60 or 70? So then you need to question yourself. So compare with £10. In terms of labor cost, again, what we need to do, we need to calculate the labor which is was that £415,000, 125. You divided by how many hours? 61,500. Yeah, 6.75. So here 6.75, and again, so that's the actual, isn't it? Compare with this, look, direct labor, we have 2.5 hour, and each hour we pay £6.50 per hour. Here we pay 6.75. Here we go. In terms of the variable overhead, the actual one is, so here we go, the question gives you straight away this, so you don't need to worry about it. So 3.5 per labor hour compared with a £3 here, £3 here. Okay. In terms of fixed overhead, its actual fixed overhead fell by £4,525. So what we need to do, we need to minus this, so £25,000. So £25,000. If you take away 4,000 to 500, £25. So this is 20,475. Okay, so this is the actual fixed cost. Actual fixed cost. Okay, dokie, that's clear. So the question number 1 asks you to calculate the budgeted profit and the actual profit. So when you calculate the budgeted profit, so you need to remember something. So when we do the variances or the operating statement, we have two methods. We have absorption, and also we have the marginal. Look, so first of all, we are gonna do it based on absorption costing method, right? So this is what we're gonna do right now. So based on absorption. So when I say absorption, we need to include all the costs, including the fixed cost, So if you look here, the budgeted profit, very simple. It's the selling price, the budgeted selling price minus the total cost per unit. Very simple, isn't it? So 50, if you minus by 45, that's £5. And if you multiply by number of budgeted units, 20,000 units, you should be able to find the budgeted profit. Let's have a look at the answers. So if you look here, you will see, yeah, that's right. You will see £50, that's minus £45 equals £5. So this £5, it's called standard profit margin or budgeted profit margin, right? Remember this, guys. Standard profit margin or budgeted profit margin. This is, we use it in order when we calculate sales volume variance. Standard profit margin. If you multiply this by 20,000 units, you should be able to find the budgeted profit of £100,000. Easy. In terms of actual profit, it's absolutely the same. Look, what you need to do here, total sales. So you don't need to multiply by number of units because the figures are in total. So the total sales equal this 1,686,500. And then you need to take away all the costs, including this material cost. You need to take away this, which is the labor cost. Also, you need to take away, this is the fixed cost. Also, you need to take the variable overhead, but the total variable overhead cost is not available. So what you need to do, 3.50 per labor hour, you need to multiply by the actual labor hours, which is 61,500. So 3.5, if you multiply by 61,500, that's 215,250 pound. Okay, and that's exactly here. That's the total variable cost. Okay, variable overhead cost. So if you add all the costs, these all the costs available. So sales minus all the costs, these are the actual profit, which is 109,700 pounds. So this is the way we calculate the budget profit and actual profit based on the absorption costing method. As you see, we included the fixed cost here. So now, as you see, the actual profit is 100 and the budgeted profit is 109,700. As you see, this is difference, isn't it? So this difference is due to the variances. Okay? So now what's our job? We need to calculate all the variances, and after that we need to prepare the operating statement. So the first variances we will start with is the sales variances. So I give you all the formulas, 10 formulas you should have with you. And you go and start first with the sales variances. Right, as you see here, there are two ways to calculate variances. It's up to you which method you're gonna do it. You can do this, or you can do the formulas, which the one I give you. It's up to you really. So answers are here for this method. I will do the what we call it, the formulas. So let me do the formulas and we can check the answers here anyway. It's fine, let's do it. So there is no formulas anyway, let's do it. Here we go. So the first one, sales variances. Okay, and sales variances, and if you remember, it's divided into two. So the first one is sales price variance. So sales price variance, so actual, the formula actual selling price per unit minus budgeted selling price per unit. Of course, when I say selling price, I mean per unit, yeah? So that's in bracket, and 1, 2, 2, 2. Then you multiply by the actual sales units in units. Okay, lovely. Okay, so this is the formula here. Okay, so sales variances, this is heading, and the first one here says this one. Let me put this in. Here we go. Lovely. So let's apply the formula then. Okay, okay. Oops, what's that? Oops. Yeah, here we go. Actual selling price per unit, guys. Come on, let's have a look. What's the actual selling price per unit? The actual selling price per unit is what? Is 53 pound, the one we calculated, minus the budgeted selling price per unit is 50 pound. So 53 minus 50, and then you multiply by the actual sales units. So the actual sales unit is what? Is actual sales units 2,500. So basically let's do it together. So 3 times 2,500 equal 61,500 pounds. So 61,500 pound. So this is the variances, and of course it is favorable indeed. Yeah, why it's favorable? As you see, it's the actual selling price is more than the standard selling price. So this is 61,500 pound is the sales price variance. So let's go here, and yeah, is the same answers, 61,500. Okay, great. So now let's move to the second formula for sales, which is here we go to sales volume. Sales volume variance, isn't it? And the formula let me write the formula. Actual sales units minus budgeted sales units, and then you need to multiply it by standard profit margin. Okay, lovely, great. So now, okie dokie, now this one, this is the formula for sales volume one. Okay, oh come on, what's that? Right, here we go. Excellent. Right, let's do it then. Come on guys, are you with me? Yes, excellent. Right, actual sales units. What's the actual sales unit? 2500. Okay, so minus budgeted sales unit. Let's have a budgeted, if you remember, is it 20,000? Go back to the question, and then you multiply by the standard profit margin. If you remember, the standard profit margin or the budgeted profit margin is here. Look, this one. 5. Yeah, can you see? Where is it? Yeah, this one. Standard profit margin. Yeah. So 5. Okay. Is it 5? Yeah. 5. And then let's do the answers. So 500 times 5 equal to 500 to 500. And it's favorable or adverse? Of course it is favorable. Yeah. Okay, why is favorable? As you see guys, it's very simple. The actual sales in units more than the budgeted sales, so that's why it's favorable. Okay, this is one. Okay, right, so okay, yeah, here we go, the answer's right here. Well done, good job, the answer's right. Okay, great, excellent. So now let's move to the material variances. Okay, material variances, and the first one we need to look at material price variance. Material price variance equal standard price minus actual price multiply what's that? Actual quantity. Okay, so let's apply. Okay, here we go, let's apply. Okay, standard price, look at the material. Yeah, what is the standard price for the material? Okay, let's have a look. Standard price for the material, direct material, 2 kilogram at 10 pounds. So that's 10 pounds, that's the standard, the budgeted, and the actual one is 10.60 pence, isn't it? So 10 minus 10.60, so that's 10 minus 10.60. Okay, and then you multiply it by the actual quantity. So if you look at the actual quantity, it is 30,750. So 30,750. Here we go. Right. So if you do this, so 10 minus 2, that's 0.6 times 30,750. So this is 18,450 pounds. And of course it is adverse. Why it's adverse? As you see here, our actual price per kilo, it's more than the budgeted one, so we paid more. Yeah, this is why it's adverse. Okay, this is the material price variance. Okay, here we go. Oh look, let me do this, maybe do this with this, or maybe here this formula bold. Yeah, that's better here. Maybe can bold this. Yeah, that's lovely. Right, we talk about material usage variance. Okay, for material usage variance, the formula is standard, right? Standard quantity minus actual quantity times the standard price. So here we go. Let's apply. Come on. So what is the standard quantity? If you remember how to calculate the standard quantity, I hope you do. I hope you do remember. So if you look at the question, you will see that the required is 2 kilogram, isn't it? That's the required, isn't it? Material for per unit, yeah, for a unit. And in order to calculate the standard quantity, what you need to do, this required 2 kilogram, you need to multiply it by the actual output, which is 2,500 units, which is the production units. So here we go. Let's do it, guys. So that's okay. That's 2 kilo times 20,500. That's 41,000 kilogram. So 41,000 kilogram. Okay, that's great. So minus the actual quantity. So if you look at the actual quantity, you will see the actual quantity is 30,750, is it? Yeah, 30,750. 30,750. Okay. Times standard price. What is the standard price? Standard price, if you go back, you will see that the standard price equal 10. Let's do it. Okay. So that's 41,000 minus 30,750 equal 10,250 times 10 equal 102,500. So that's 102,500, and of course it is favorable. Why it's favorable? Because as you see, right here, look. So we used less material than budgeted one, so that's why 102,500 is favorable here. Okay, that's great. Okay, here we go. Right, material done. Now we need to move to labor. So labor variances. Okay, labor variances. I know why it's in red, because Americans, look, English United States, and if I put an United States, but I'm not sure it's automatically, but what we can do, we put all Control A and move to United Kingdom. So here we go. So now there is no error, isn't it? Yeah, I know. Right, so labor variances. So for labor variances, so you need to look at two formulas. So here we go. Two formulas. Here we go. So first one, labor rate variance. Okay, labor rate variance, which is the same formula as a price variance, but instead of P price we put R rate, and instead of QH hours. So let's do it. So that's standard rate minus actual rate, and this divided by actual hours. So here we go. Let's apply then. Standard rate. So if you look at the question, you will see the standard rate for labor 6.50. What is the actual? Hey, 6.75. The actual 6.50. 6.50 minus 6.75. Yeah, that's right. Multiply the actual hours. So as you see, the actual hours is what? Is 61,500. 61,500 is the actual hours. 61,500. Here we go. So let's do it. So that's 0.25 times right, 61,500. So that's 15,375, right? And of course it is adverse. Why it's adverse? As you see, we paid more labor rate than budgeted, so that's why. Okay, good. So let's find out. Let's see. So go back. Okay. So for material, we check this 18,450 material price and 102,500 material usage. That's right. For labor rate 15,375. That's right. Okay, sounds perfect so far, isn't it? Yeah, AF, isn't it? Yeah, it's perfect. Okay. So now for the second one is labor efficiency variance. So with labor efficiency variance, again the formula is the same as this, the material usage variance, but we change instead of Q, H, and instead of PR. So that's standard hours minus actual hours times standard rate. Okay, here we go. Right, so in terms of standard hours, it's the same way we calculate standard quantity, if you remember. So if you look at the question, you will see that the required time is 2.5 hours, and this you need to multiply it by the actual output, which is 20,500 units. So 2.5 times 2,500, so that's 51,250. Okay, 51,250. That's lovely, excellent. And the actual hours, we have it here anyway. It's 61,500. That's nice. Where is it? Yep, nice, excellent. Standard rate. Oh, come on, what's that? Standard rate is 650. Okay, lovely. So let's do it. 51,250 minus 61,500 times 6.50. Yeah, 66,625. What was that? 66,625. So this is the answer. So of course it is adverse. Why is adverse? As you see, the actual hours used is more than the standard hours, the budgeted hours. So we use more hours. So let's make sure it's the right answer. 66,625. Yeah, that's right. 66,625. That's right. Okay, that sounds perfect. So what's left now? We have variable overhead now. Variable overhead. Okay, right. Okay, okay. Now it's the variable overhead. So variable overhead. So when it comes to variable overhead, so again we have two formulas, but the good news is the same formulas here. Absolutely the same, because I did tell you that variable overhead follows the labor. We absorb using the labor. So, and also the question tells you if you go back to the question. So anyway, so let's do it then. So we have variable overhead spending. Again, I told you the same formulas with this, absolutely the same. So copy paste. Here we go. Okay, let's do it. Okay, variable overhead. Oh, VO. What is the H? Here we go. Right. Standard rate for variable overhead. Let's have a look. Okay, can you see variable overhead based on labor hours? Yeah. Even the question doesn't tell you, it's, you assume that's based on labor hours. 2.50, £3. The rate is £3. So is it £3? And for the actual one is 3.50. So 3 minus 3.50. So 3 minus 3.50. And oops, what's that? Oh my god. Oh no. Yeah, here we go. 3 minus 3.50, and then you multiply it by the actual hours. And if you remember, the actual hours is the same as total labor hours, because if you look at the question, there is no actual hours for variable overhead. We need to use the number of actual labor hours here. Okay, 61,500. Okay, that's right. Let's do it. So 0.5 times 61,500. So that's 3,750. Okay, lovely. It is adverse or favorable? Of course, it is adverse. Why it's adverse? As you see, so the actual rate is more than the standard budgeted rate. So that's right. Okay, let's just make sure it's the right answer. Yes, 30,750. That's correct. So, second formula for variable overhead is the variable overhead efficiency. And again, so the formula is the same one here. Okay, like this is the same exactly, this one. Okay, the same. Where is it? Here we go. Ooh, yep. So standard hours. So standard hours is the same. If this one should be the same as labor, because if you look at the question, yeah, you will see that the required hours is the same, isn't it? Here, can you see it's the same here? Why? Because that's obviously anyway should be the same, because we used labor hours to absorb the variable overhead. Easy. So, and actual hours is the same, of course, in terms of actual hours. Then you need to change this. Standard rate for variable overhead is 3. So answers should be 51,250 minus 61,500 multiply 3. Okay, yeah, 30,750 pound. Is it the same? No, come on. Is it? 60 again. Let me do it. 51,250 minus 61,500 times 3. Standard rate is 3. Yeah, that's right. 37,750. Interesting. 30,750. Of course, is adverse. Why? Because the actual hours is more. Yeah, 30,750 pound. Right. So let me just check. Okay. Right. Okay, dokie. Okay, dokie. Variable production overhead efficiency. Where is, yeah, the same. Yeah, that's right. Yeah, actually, that's right. Yeah, that's 30,750 pound, and this is 30,750 pound. That's right. Yeah. So don't be surprised, guys, if you have the same answers for the same variances. That's interesting. Anyway, right. Okay, dokie. Now, what's left? Yeah, last one. Fixed overhead. Fixed. Oops, what's that? Fixed overhead. So with fixed overhead, okay, yep. Okay, we have two formulas for fixed overhead. So first one, the fixed overhead spending. Okay, so let's do the formulas. So budgeted fixed overhead minus actual fixed overhead. Here we go. That's great. That's lovely. So what's the budgeted fixed overhead minus the actual fixed overhead? So let's have a look. Yeah, the budgeted fixed overhead is £25,000 and the actual fixed overhead is 2475. 2475. So that's 25 actually, isn't it? £25,000 minus 20,450 So is it 2450? Let me check. 475. 475. Yes, that's right. Yeah. See the answers for this then. Come on, where's the calculator? Here we go. So 25,000 minus 2475. So that's 4525. 4525. And as you see, it is favorable, of course. Why? Because as you see, the actual we spend is less than our budgeted. That's great news. Okay. And now the last formula. Right, 10 formulas. The last formula we have, guys, is the fixed overhead efficiency. Okay. Or we call it or maybe volume, maybe it's better. Yeah, let's do that. This one. So in terms of this, so actual production units. So how many units we produced, actual one, minus budgeted. Come on. Budgeted production units, that's right, and then you multiply it by OAR. Okay, that sounds good. OAR stands for overhead absorption rate. Okay, let's do it. Okay, or actually I will make it a new line here. Is better actually. So yeah, come on guys. So actual production units, oh come on, production units minus budgeted production, actual production units minus budgeted production units. Or right, let's do it. So what is the actual one? So of course, guys, as you see, the actual production units equal the sales units, so it's the same, they are equal. So the actual production is what is it, 2,500, and budgeted 20,000. So here we go, let's do it. So 20,500 minus 20,000, and then you multiply by OAR, which is overhead absorption rate, or in other words, it's fixed cost per unit. Yeah, the fixed overhead, the budgeted fixed overhead per unit, which is the 1.50, 1.25. This is the what we call it, yeah, fixed production overhead per unit, fixed production overhead per unit. So so if you have this one, okay, what is it? Oh, okay, did we check this first? Yeah, we checked this. Okay, great. So we check this 4,525. Did we check it? Yes, that's right. Okay, that's correct. Okay, just make sure we have the right one. So now then you need to calculate 1.25. As I said, this is fixed cost per unit, or the overhead, the budgeted fixed cost per unit, or the overhead absorption rate. So 500 times 1.25 equals 625. And of course it is favorable. So why? Very simple, because as you see, we produced more by 500 units than expected. Okay, so 625, let's check. Here we go, that's right, excellent. Here we go, and save. So as you see, guys, we followed the 10 formulas. So these 10 formulas, let me put them in one page. Yeah, here we go, 10 formulas. 10, is it 10? Yes, 10, 2, 4, 6, 8, 10. That's right, 10 formulas. And these formulas, it's different ways from this way, this method. It's up to you which one you're gonna use, guys. It's absolutely up to you. So it's up to you. You've got the two methods and you feel free. So in terms, if you are stuck with A and F, adverse or favorable. So if you don't want to think straight away, if a positive number, favorable, negative number, it is adverse. So that's straight away if you don't want to think. 10 formulas in front of you will help you a lot instead of like confusing.com. But when you have the 10 formulas in front of you, that makes your life easier. So once we have the formulas, that's it. Job done. 90% done from the question. What you need to do really, you just need to prepare the operating statement. And the operating statement, very, very simple. It just, you need to just plug numbers there, really. Look. We start with operating statement using absorption costing. Don't forget. We start with, okay, with what? What is that? Yeah. With budgeted profit. So the budgeted profit, the one we calculated. Look, let me help you with this. Where is it? Yeah, here we go. The budgeted profit is 100,000 and the actual profit 109,700. So that's the most important thing here. So as you see, this is what we start, budgeted profit, and we end with the actual profit 109,700. And we need to see the differences in variances. So this is the way you need to first list the sales variance in terms of a price, in terms of volume. So this is the answers. You just copy paste the answers. So yeah. So this is, of course, this is favorable. This is why positive. So it treat positive, favorable as a positive number, and adverse as a negative number. But both of them, if you go back to the answers, these are positive. So the equal is 64,000. So 100 plus 64 equal 164,000. Then you need to list all the all the cost, and you list them under really favorable one or adverse one. So you go back to the answers and you can see. So these are the total and the net figures here for cost variances. So as I said, this is minus, this is positive. So 54,300 minus, in this case 164,000 minus 54,300. So that's equal, the actual profit is 109,700. So as you see, guys, what we did really, we reconciled the budget profit into the actual profit using the operating statement and due to variances indeed. Okay, this is the operating statement and this is all the variance. That's all, guys. So the only things quickly which you need to understand, if the question asks you to calculate it or prepare the operating statement using the variable costing or marginal costing. So remember, if the question doesn't tell you which method you are using, so always go with the operating statement, which is operating statement with absorption costing. So always remember, use the absorption costing method. But the question, if it specify, so marginal costing or variable costing, so you need to stick with variable marginal costing. So, right, when it comes to marginal costing, is 90% of the answers are the same, completely the same. So the one trick here, which is this one. Under absorption costing, if you remember, we used 5, which is the standard profit margin, which is what? The standard profit margin, the budgeted profit margin. And when we calculated, if you go back, you will see that we calculated here £5. We included all the costs, the £45 under absorption costing. But under variable costing, you need to understand that we do not include the fixed cost per unit. Okay, we don't include the fixed cost per unit. Remember this under marginal costing. Okay, so you need to do a new budgeted standard profit margin without 1.25, and the same with the actual profit. Remember that you do not include the fixed cost, so don't include this. So the first step is to calculate the actual the budget profit and the actual profit using marginal costing, and which really here, so these are the answers. So the budgeted profit or contribution anyway is this, but as you see here, guys, it's now the standard 43 the cost, not 45. Yeah, can you see? Because we take away the 1.25 is the fixed cost per unit. So now the standard profit margin which you're gonna use is 6.25, isn't it? 6.25. This is the one you need to use it in order to calculate the variance for sales volume variance. Sales volume variance, the same as absorption costing, absolutely the same, but instead of 5 is £6.25. This is only one variance you need to calculate it, just only this variance, nothing else. But of course you need to calculate the new budgeted profit and the new actual profit. And again, that's based on what, guys? Based on the as I mentioned, based on the new marginal costing, which you need to take away the fixed cost. So when it comes to operating statement, it's 90% the same, but the trick here, which as you see here, that when it comes to budgeted profit here, so you need to add up the budgeted fixed overhead. This is the first fixed overhead. The budget fixed overhead is it's 25,000 according to the question. If I wasn't wrong, let me check. Yeah, 25,000, the budgeted fixed overhead. You need to add it. So the budgeted contribution 125,000. And then you do the sales variance as normal, which we've done, everything the same. And what about the other fixed overhead? So this other fixed overhead, this is actual fixed overhead, the 2,475 you included at the end here. You included at the end here. But as you see from the cost variances, we don't have any fixed cost. We don't have any fixed cost. So basically, when it comes to marginal costing, so you don't need to calculate the fixed overhead variances. No need. You really need to calculate. You need to include the budgeted fixed overhead, which is 25,000 here at the top, and the actual fixed overhead, which is 24,475 here. So that's the only way you do it. Okay. Right. Okay. I think that's all, isn't it? Okay. Yep. So that's all. This is variance equations. It's very important to remember when it comes to variances. As I mentioned, the key is to give the formulas done in front of you and practice. It's not really difficult as long as you've got the formulas in front of you. And this is the end of the seminar. Thank you very much. God bless.